Strategies for retirement transitions, the distribution stage. This week on WealthWise. Thanks for joining us. Last week we talked about legacy, what you leave to your heirs. The other phases are accumulation, which starts when you start working and ends with your last paycheck. And when you get your last paycheck, you enter into transition. And transition lasts through age 72. At age 72, distribution starts. And that means living off your resources for the remainder of your life. Today, let's talk more about distribution or spend down. During distribution, you're funding and maintaining your lifestyle after you're 72. And we would like to define the cost of your retirement. What is your life going to look like? And do an analysis of your financial capacity. And let's see if you're on the right track. Define the cost of your lifestyle and create clarity. How do we create an income stream? How do we maximize income and minimize taxes? And when we analyze financial capacity, we focus on after-tax, risk-adjusted market returns, as this is the only way to get those unrealized gains that we spoke about last week. With your latest tax return and investment statements, we can create a crystal clear picture for you. Doing this increases your odds of not running out of money and helps keep the portfolio intact. Determine your Social Security strategy. Maybe you should think about it a little earlier than 70, but it's in the distribution phase because most people waiting until age 70 is how you maximize the amount you receive from Social Security. But that's not always the case. Planning will tell us the best time for you to start. Many people wait until age 70 to begin their Social Security, but they make a conscious decision to do so well before age 70. A lot of people tell us they just want to live off their interest and their dividends and not spend their principal. You've been told defer, defer, defer your entire life. However, the federal government forces you to end deferral and spend your money and pay taxes. That's why we call it spend down, because you are forced to spend down your assets. And the deferrals for your retirement end when you enter the distribution phase at age 72. You need a strategy and a way to execute it. Not only is lifestyle important, but so are charitable intent and end-of-life costs. And we want to increase your odds of not running out of money. When you enter distribution, you lose a lot of control and you lose a lot of flexibility. You must start Social Security at age 70 as there's no advantage to waiting longer. And at age 72, you must begin withdrawing required minimum distributions from your retirement accounts. How much do you have to withdraw? Well, there's a formula, and it's based on your age and your account balance at the end of the previous year. At age 72, the first year starts at about 4%, and every year thereafter it goes up, and it goes up, and it goes up. Know your RMD amount and take it early in the year, or at least equally over 12 months. Don't live off all your other assets and then at the end of the year go, oh, I've got this RMD, and get a big check that pushes you into a different tax bracket and a lot higher taxes. Two things happen in distribution. Your Social Security is getting cost of living increases, and your required minimum distributions are increasing. Don't get me wrong, everybody likes raises. But when you add interest, dividends, capital gains, maybe some rent on top of your RMDs and your Social Security, you might be shocked at how much taxes you're paying in retirement. Had a client in the office this week, and she was very much concerned about how much she was paying in taxes. She's 65, her husband is 68. And she said, I just thought the federal government would give senior citizens a break, but look how much money we're paying in taxes. It's a lot of money. It's going to happen to you as well. These things add up. They create lots of taxes. We use a program called Money Guide Pro, and we use that to project where you will be in the future. It shows your minimum income and your minimum taxes that you have to pay. So managing your income helps you reduce your taxes. If you can keep your adjusted gross income to $112,000 or less, you do not have to pay taxes on qualified common stock, on dividends, on long-term capital gains. If you keep your modified adjusted gross below $182,000, you do not have to pay extra Medicare taxes. But if your income goes from $182,000 to $182,100, that additional $1 creates $2,000 in additional Medicare cost for a couple. So we know what we're forced to do. But how can we reduce taxes when we reach the distribution phase? More and more people are utilizing the standard deduction now, because it's $28,700 for folks in distribution. 3 years ago, it was $12,000. So it was a much easier hurdle to get over, and many people itemized at that time. Now we mostly see folks use the standard deduction. Once you're here, it's more beneficial to give to your church, the Girl Scouts, the YMCA, UGA Foundation, by having your IRA write a check to the charity. The check is made payable to the charity, it's sent to you, and you deliver it to the charity. And as a result of that, you get both a charitable deduction and a standard deduction. It's a very tax-smart way to give. This is called a QCD, or a qualified charitable distribution. And the money you take out of your IRA to give to charity helps satisfy your required minimum distribution each year. The maximum amount allowed per year is $100,000, and it can only come out of an IRA. I recently made this point in front of a group, and I was asked how it would be for a couple who had $100,000 of income and withdrew an extra $20,000 from their IRA to make a gift to their church. If you take $20,000 out of your IRA, deposit it in your checking account, and then give it to the church, at the end of the year, you have to include that IRA withdrawal as income. Now, if your state tax, your property tax, and your mortgage interest on top of the $20,000 you gave to the church, let's say totals $30,000, then you're larger than the standard deduction, so you itemize. So in this case, you had $100,000 of income, plus a withdrawal of $20,000 from the IRA for a total income of $120,000, and you get a $30,000 itemized write-off. So you have $90,000 in taxable income. The taxes on that are $11,000 in federal taxes. Instead, if you have your IRA make the check payable to the church, and it goes directly to them rather than you depositing it, your income at the end of the year doesn't include that $20,000 because the IRA check was not made payable to you. You still get the full standard deduction, so now you have $100,000 income, less the $28,700 standard deduction, which gives you a $71,000 taxable income. Federal taxes are $8,000. Your living income did not change from the two scenarios. It was $100,000 in both. In both scenarios, the church got $20,000. That didn't change. What changed was in scenario one, you paid $11,000 in taxes. In scenario two, you paid $3,000 in taxes. So doing qualified charitable distributions for most people makes sense. Now, there's a caveat to this. And that is, when you go see your tax preparer, your 1099 is going to say you withdrew $50,000 because custodians don't differentiate what you do with the money. So what you have to tell your tax preparer is $20,000 of this $50,000 out of my IRA went to my charity. So on your tax return, they put received $50,000, amount taxable $30,000. Also, in the first scenario where you deposited the IRA check, your adjusted gross income exceeded $112,000. So now you have to pay taxes on dividends and capital gains. And the second, using QCD, you didn't. So we can dig deep in your tax situation. We have a program called Holistic Plan. And this is a program that looks at your tax situation from ground level. And it gives you tax-saving tips. Another bullet point, funding remaining lifestyle spending with lower tax cost investments. In addition to Social Security and required minimum distributions, if you are supplementing your income, do it in a way where you lose the least amount of wealth to taxes. In your taxable account, change your dividends and your capital gains to cash. You've got to pay tax on them whether you take them in cash or you reinvest them. Don't reinvest and then in 6 months sell to raise the cash. You could end up paying tax twice doing that. To the extent that you need more income, sell stocks with high basis and up markets sell bonds in down markets. Gaining income this way creates very, very small tax bills. Transfer wealth to heirs. If you have the resources, you can give $16,000 to anybody you want. Normally it's to children, grandchildren, relatives, family members. When you give somebody a Christmas gift, they don't have to pay tax on it. When you give somebody $16,000, they don't have to pay tax on it. Now, if you give them cash, they can do with it whatever they wish. If you give them something other than cash, such as stocks, real estates, whatever, your cost basis goes with the gift. If you give them cash, that is the cost basis. But if you give someone a stock, their cost basis is what you paid for it. It's not the current value. And if they sell it, any profit is taxable to them. Now remember, we talked about step up last week. So if property is received as a bequest at your death and not as a gift, it receives a full step up in basis and can be sold tax-free. Create and share a legacy plan with family. Gifts do not have strings attached to them. So the receiver can do whatever they wish with a gift. Now you can make recommendations. What you want to do here is to make sure that your heirs know your values. Sometimes it's better to give with a warm hand than a cold one. That way you get to enjoy seeing the loved one benefiting from your gift. In conclusion, while the distribution phase has a lot of you must take Social Security, and the government forces you to start spending your assets, there are things you can do to increase your odds of living the life you want, not running out of money, and reduce your taxes. If you have any questions about anything we've discussed, please feel free to reach out to us. We created a 5-page workbook, Strategies for Retirement Transitions, that I used as the basis of our discussion in this series. If you'd like a copy, please email marketing@elevate-wealth.com and we will gladly send you a copy. Thanks for watching. Hope to see you next week.